The S&P 500 trying for yet another record closing high today, and that's after erasing earlier losses following the jobs report. Let's bring in Kevin Gordon, senior investment strategist at Charles Schwab. Welcome back. It's good to see you.
Good to see you.
I want to go right where we teased you at. Take some profits in the high flyers. I mean, why?
Well,
why not ride them?
Yeah, I mean, it doesn't make sense for, again, every single investor. We have more than 30 million investors.
I know, but that's
across 9 trillion assets.
I know. But
you know, I was thinking back to when we wrote our outlook for this year, 6 months ago, maybe 7 months ago, and kind of this whole notion that we've, had for a theme that we've had for the past couple of years, which is rebalancing maybe less based on the calendar, more on a volatility basis. And it's not, just back up the truck, dump everything that's been a high flyer and then add to what's not working. It's just kind of don't be afraid to take some profits when you have these outsized gains, whether it's in a single name, you're all, obviously the focus is on NVIDIA this week or today.
Isn't your focus
or
on
if it's
NVIDIA too? I mean, aren't you zeroing in on things like that when you make a call like this?
It's interesting because if you look at the, the contribution to the gain so far, not just year to date, but maybe, take it over the past 4 to 5 weeks. If you did take out NVIDIA from the S&P, you wouldn't be back at an all-time high. You've actually been trending just a little bit lower. But looking at the, zooming out a little bit, broadening the picture, the rolling 30-day or 60-day correlation between changes in NVIDIA and changes in the S&P 500 has come down from about 0.9 earlier this year, mid last year, now to about 0.3, 0.4. So it's good because you can still see gains in a name like that or in a sector like tech, but you don't necessarily have to rely on it as much or see a gain there to have a gain in the rest of the market, which I think is a constructive thing.
When you work for a firm like Schwab, which has such a dramatically large retail cohort using your business, and you see things like GameStop and NVIDIA, what do you think?
I think that...
what are you guys telling people?
Going back to your, I think, discussion back with Cameron and Tom, just about risk appetite and how sometimes you can see risk appetites really come back. Even in a time, you compare it back to the meme craze in 2020, 2021, we were in a totally different economic situation. We were in a totally different rate structure, rate situation. And I think that, it probably speaks to maybe something that shifted a couple of years ago where there's been this kind of cult of equity that has come in and maybe had some staying power. But I think that, the point that Cameron was making in particular about this being much narrower in focus. It hasn't really spread to the IPO world or hasn't spread to the SPAC world. Both of those areas of the market really haven't come back to life as much. So it's kind of a whack-a-mole situation where you've got individual names that have these moves every now and then. But, I think it speaks to the broader environment and risk appetite situation for some investors still willing to lean in.
I mean, it's pretty remarkable when you hear, somebody from Interactive Brokers, for example, on our network earlier today say, it's the second biggest stock in terms of trading activity for us behind NVIDIA. That says everything, though, when these two stocks are dominating the action and the narrative and everybody's attention.
And I will say, though, I've been over the past 6 months, fortunate enough to have traveled the country, visiting different clients and speaking and listening to them. And I think what's been consistent, and we often find this, especially in turbulent times, whether it's a lot of volatility to the upside or the downside, clients that make it through these periods the best are ones that take more of an advised approach. So if you're not focusing as much day to day on these swings, and yes, there's going to be exposure to the NVIDIAs or the GameStops of the world, but if you're not getting as caught up in that, and if it's not the huge chunk of your portfolio, then we find that clients write that out better.
What about just the market in general here as we, here we are in June, right? We're almost at the halfway point. What's your outlook? Are you optimistic?
Well, I will say we're putting together. Lizanne and I are putting together our mid-year. It publishes on Monday. So, but generally the outlook, and I think what has changed over the past couple of weeks, a little bit for the worse. Not detrimental, not fatal, but you've had a steady deterioration in breadth. So far, it's been concentrated more in the percentage of companies that are above their 50-day moving average. If you're looking in the S&P, but it hasn't yet filtered over into the percentage that are above their 200 days. So for the most part, you've got 70% of names in an uptrend. I think that's relatively healthy. So as long as you go through that consolidation, you go through this rotation, as that metric stays relatively healthy, I think that's a good thing. Coupled with the fact that from a broader macro picture, when you look at where we are with GDP, which is still slightly above trend if you're looking at it on a longer term basis, and then inflation, which is still a little bit below trend, again, if you're looking at it on a longer term basis, that tends to be the best zone for the equity market. And it's still relatively healthy, even if you downshift with growth slipping a little bit, at trend or below trend, and inflation still staying below trend. The real difficulty you get to is when inflation, or if inflation, gets above trend again.